Once again, sorry about the cutting off of the video. We left off talking about the capital structure, and in this slide we're talking about capital structure and shareholder wealth. The primary goal of financial managers, as we've talked about pretty much all classes, to maximize stockholder wealth, and maximizing shareholder wealth is kind of equivalent to maximizing the firm's value or minimizing the weighted average cost of capital. So in a sense, your objective is to choose the capital structure that's going to minimize your WACC and maximize stockholder wealth. And there's an effect of financial leverage. We've already discussed the fact that you can think of leverage as the use of debt. Leverage is going to amplify the variation in EPS and ROE. Right now we're going to ignore the effect of taxes at this stage. So if you asked yourself what happens to EPS and ROE when we issue debt or buy back shares of stock, what would happen is EPS would increase, as would ROE. So if we increase debt to buy shares, or if we decrease shares outstanding, EPS and ROE would increase. The text now goes into a little bit of an example here between this fictional corporation, Trans Am, I believe, and a current state of affairs and a proposed state of affairs. In the current state, they don't use debt at all. In the proposed state, they would use $4 million in debt. So in that sense, it's kind of a either a 100 equity stake over here or a 50-50 debt equity split. And then they go through some situations of looking at different potential scenarios, like a recessionary scenario, a baseline or expected scenario, and then an expansion scenario, and look at the specifics of how the increase in debt would impact the ROE and EPS. So what we found is that adding debt to the capital structure is basically going to magnify upsides and downsides. So you're going to see lower lows and higher highs. For ROE, we saw that the ROE ranged from 6.25 to 18.75 with the current. But when you added the debt mix in there, it went from 2.5 to 27.5. Same thing with variability in EPS. Basically, we found that, once again, lower lows and higher highs when you added debt to the equation. So the variability in ROE and EPS increased when financial leverage increased. Sometimes it's useful for firms to find a break-even EBIT. And this next chart is going about showing how you could go about finding the break-even EBIT. So here we have EPS is going to be for equal for the capital structures. You have EBIT over your 400,000, and then you're going to have EBIT less the 400,000, which is your current shares outstanding, over the proposed shares outstanding, which is this 200,000. And if you do the math, it breaks down to $2. So this is detailing the calculations required to find this break-even EBIT. And once again, this is the EBIT which results in the same earning per share regardless of the firm's capital structure. So here is a little bit of a different point of view, a chart point of view on this break-even EBIT. Here, if we expect EBIT to be greater than the break-even point, when leverage is beneficial to our stockholders. If we expect EBIT to be less than the break-even point, then leverage is detrimental to stockholders. You can see the steeper line is with debt. Anyway, the conclusions from this brief analysis on Trans Am Corporation was the effect of leverage depends on EBIT. When EBIT is higher, leverage is beneficial. Under the expected scenario, leverage increases ROE and EPS, and shareholders are exposed to more risk with more leverage. ROE and EPS are more sensitive to changes in EBIT. Now, there's some theory involved with capital structure. We kind of went through how capital structure is going to affect shareholder wealth. There's some theories attached to this as well, and we're going to walk through these. The first one is Magliani and Miller, who are Nobel laureates, and this was their first published work relating to the capital structure with firm value. They have two different propositions. One's the pie model, and this is the value of the firm. You can think of it like a size of a pie, and it's not related to how the firm is financed. The other one, proposition 2, deals with the weighted average cost of capital. And here they say the cost of equity is going to depend on the required return on a firm's assets, the required cost of debt, and the firm's debt to equity ratio. So let's go through some of their theory here. It involves a lot of assumptions. As you can see here, case 1 assumptions: no corporate or personal taxes, no bankruptcy costs. Obviously, that's not a reality. Case 2 assumptions: corporate taxes but no personal taxes and no bankruptcy costs. Obviously, that's not a reality. Case 3, corporate taxes but not personal taxes, and there are bankruptcy costs. So none of these cases are perfect. So for simplicity, we're just going to skip through here. As a real quick aside, a big concept here is bankruptcy costs, and you saw that in the assumptions page. The text goes through a little bit of detail into bankruptcy costs. They talk about direct costs. These are legal or administrative costs, and they give the example of Enron and WorldCom and their direct costs. Bondholders incur additional losses. There's a disincentive to debt financing. And then with financial distress, there's significant problems meeting debt obligation. Most firms that experience financial distress do not ultimately file for bankruptcy. So there's the direct costs, but there's also indirect costs to bankruptcy. These can be larger than direct costs, but more difficult to measure and estimate. Stockholders may wish to avoid a formal bankruptcy. Bondholders want to keep existing assets intact so they can at least receive that money. Assets lose value as management spends time worrying about avoiding bankruptcy instead of running the business. You have lost sales, interrupted operations, and loss of value employees, and so on. So indirect bankruptcy costs, this is an important definition here, are costs incurred by the firm trying to avoid filing for bankruptcy. Okay, so like I said, we're skipping kind of through this, but I'm just going to show you the conclusions here for this theoretical approach. With the first case, there was no taxes or bankruptcy costs. The thought would be that there's no optimal capital structure then. In the second case, where there's corporate taxes but no bankruptcy costs, the optimal capital structure was 100% debt. And the primary reason for that was this: no bankruptcy costs. Each additional dollar of debt increases the cash flow of the firm. In case 3, there's corporate taxes and bankruptcy costs. The optimal capital structure is part debt and part equity. And this would occur where the benefit from an additional dollar of debt is just offset by the increase in expected bankruptcy costs. So this slide provides some additional managerial recommendations. As far as taxes go, the tax benefit is only important if the firm has a large tax liability. The higher the tax rate, the greater the incentive to use debt. As far as risk of financial distress, the greater the risk of financial distress, the less debt will be optimal for the firm. The cost of financial distress varies across firms and industries. Okay, so how about observed capital structures? What have we actually seen out there in the news regarding capital structures and in different industries and whatnot? Well, first off, they're going to vary by industry. According to this 2008 yearbook on cost of capital, The lowest levels of debt were in the computer and drug industries, which are about 5%, 6% debt in those industries. Highest levels were in cable and airlines, where you had above 50% in each. A couple quick details you should be aware of. Business failure. Well, first off, financial distress defined is what we're talking about in this particular slide. Business failure would be a situation where the business is terminated with a loss to creditors. Legal bankruptcy is a petition filed in federal court for bankruptcy. Technical insolvency is when a firm is unable to meet its debt obligations, and accounting insolvency is when the book value of equity is negative. You guys are probably somewhat familiar with the bankruptcy process, but we're going to go through a real quick kind of summarization of Chapter 7 and Chapter 11 bankruptcy. First, Chapter 7. Here's the bankruptcy process as far as liquidation goes. Chapter 7 of the Federal Bankruptcy Reform Act of 1978. The process here is that there's a petition filed in federal court. The trustee is elected by creditors to take over the firm's asset. The trustee attempts to sell the assets, and the proceeds are distributed according to absolute priority rule. And this is a situation, absolute priority rule is a situation where you give debts to creditors first, and then the shareholders divide whatever's left over. As far as the bankruptcy process with reorganization, Chapter 11, the process, you have a petition filed by firms or by the firm or creditors. Usually the firm continues operation as debtor in possession. The firm submits a reorganization plan. If accepted by the classes of creditors, then it's confirmed in court. The firm makes a payment to the creditors and operates under the plan for some fixed amount of time. So the Chapter 11 is a legal proceeding that involves restructuring of debt obligations. Finally, financial management and bankruptcy. Bankruptcy can be valuable because it stops creditors from further draining your assets. The right to file bankruptcy can have strategic value, therefore. You can provide an immediate stay on creditors, the ability to terminate labor agreements, the ability to lay off large numbers of workers, and the ability to reduce wages are all potential pluses to going down the bankruptcy path. That is the end of Chapter 13. So for your quiz, I suggest you read over these two chapters, 12 and 13, and hopefully these video lectures will help in your preparation for your quiz. We'll see you next Thursday.